Welcome back. So to wrap up chapter 5 about our ratios, so we have two major ratios that we look at specifically. One is called the gross profit rate. The other one is called profit margin. So what this does is the gross profit rate basically tells us specifically how much over time the company is actually growing in their gross profit specifically. Gross profit is a big deal because what it does is that it takes gross profit, divides it by net sales. So what we're trying to look for directly here is if we were to take our gross profit, which is how much money we have left over after our sales expenses and after cost of goods sold specifically, we are dividing our gross profit back into our net sales. And the reason for that number is because that gross profit rate continues to change. So it will either increase or decrease due to the fact of the customer's willingness to buy the product. It would also change based upon the customer's likes or dislikes about the product specifically. So we watch this specifically because the gross profit rate is a big deal for businesses specifically because it kind of gives them a pinpointed area to see how well that they're performing overall. Profit margin is where we take net income and divide it by net sales. The issue that we have with profit margin specifically is the fact that we are looking at how much money the business actually grows. So how this works is the company will go ahead and figure out how much profit margin they need. Well, they'll first figure out what the break-even point is going to look like for their business, specifically from a CFO. Then they're going to go ahead and take a profit margin, and this profit margin specifically will tell them how much profit margin they need in order to maintain their budget moving forward. But what they do is they take the profit margin for the entire company and then they're going to break it down per SBU. So each SBU, which is each single business unit, which would mean for a company similar to Coca-Cola, for instance, actually I'll use Pepsi instead. So like a company like Pepsi, they have multiple different product lines, right? So if we looked at Pepsi drinks specifically, they have their soda beverage line, they have their Gatorade beverage line. Well, I wouldn't really call it Gatorade. It'd probably be sports drinks, energy drinks, fruit juices specifically. So each one of those product lines that they have a dedicated team called an SBU, a single business unit specifically that is dedicated to those products. So they would go ahead and look at the overall profit margin for the company itself and then take that number and divide that profit margin amongst the different categories based upon the products and the maturity of each one of those SBUs. Because some of those SBUs, they have new products coming out that haven't quite hit maturity or is considered to be their cash cow in order to bring in enough revenue in order for the company to stay afloat. The last part that I'm going to touch on a little bit is inventory, but inventory is really going to be moved to chapter 6. And so we have two types of inventory that we take. And one is called perpetual and the other one is called periodic. So a periodic inventory, it just like with what it says. If you're to look at the word period, it basically just means a point in time, right? So let's just erase this real quick. Inventory. So if we were to look at this, we have one type of inventory. Okay, so for inventory, we have periodic, which basically, if you know what a period means, it basically means to take inventory at one point in time, okay? Another idea instead of periodic specifically would also be known as cycle count inventory. So cycle count makes me feel psycho. It really does. It's one of the things that I hate the most. And the reason why is because it's also known as physical count. P-H-Y. Physical count. And physical count inventory basically means that you count by hand how many items you actually see. And the reason that we do that is because we want to make sure that the products are actually there. We don't always trust a computerized system. So a periodic inventory system allows me to know what I really truly have from a business perspective, right? For instance, if you guys ever gone to, like right now, with the coronavirus, if you go to Walmart or Target and you try to look for either toilet paper, wipes that have the antivirus wipes specifically, what we look at is we are referring to the inventory. So if you walk and you see the store shelf is completely empty, do you trust that they have no inventory? No, you shouldn't, because most inventory that they would have on hand would be in the back storeroom. The reason for that is because when we talk about inventory, you never want to have your shelves completely wiped out, because you're going to end up losing customers. You can't sell products if products are just left in the back, so we have to try to rotate the inventory as quickly as possible. We'll cover this more in chapter 6 specifically, but just know that periodic count is also known as physical count inventory specifically. So we take usually the end of the month or the end of the year, and we hire people to come out and physically count the inventory, because it's big for us, because we know that our inventory is a current asset that changes its value at the end of the month every month, because what we have in inventory today may not be the same value of inventory we have tomorrow. So that's one of the major reasons that we look at that. The second type of inventory, so the first one is periodic, okay? The second one is perpetual. You guys know this one really well. Hold on. All right, perpetual inventory system basically means like this. It is a computerized system. So, computerized inventory. What this means is if we were to go ahead and work for a business, and you would be part of the receiving crew, you'd be waiting for the next set of inventory to be coming, specifically from that back stock room. So what we're looking for is when we receive the product that comes off the dock specifically, that they'll call up the manager comes over there to the receiving dock, they check the bill of lading, which is called the BOL, and the bill of lading is another form of receipt specifically that we use in business to make sure that the purchase order or sales order, depending on who ordered the product, got to the right place, and we have the correct quantity that was ordered. Because there's nothing worse than receiving a product that we didn't check to make sure that we actually ordered, right? It's like the same reason as to if I was to ask you to check your receipt, you would definitely check your receipt after you went through the checkout, for two reasons, right? The first reason that you would check your inventory or you would check your receipt is to make sure that with what you paid for is exactly what's in your bag, right? Because heaven forbid you got charged for something that you didn't even buy. It happens to me, so I want to make sure that you check that. Sometimes there's scams that happen where people are scanning UPCs and claiming additional funds that you had no idea that you actually paid for. So please make sure that you check your receipts. The second reason though too is, what if you put something on the till or the checkout counter that you expected to pay for and the checker forgot to actually, forgot to add that item to your bill, right? And so you don't want to be accused of stealing. You don't want to, you just want to make sure that with what you paid for is with what you actually received. So please check your receipts. It's a big deal. So going back to the periodical inventory system, or I'm sorry, the perpetual. The perpetual is when the receiving dock receives an order, comes through, the manager checks the bill of lading. After they check the bill of lading and they already can visually verify that that product is with what's stated on the bill of lading that they were supposed to receive, then the trucking company will unload the freight truck directly with the pallets. So from the pallets, then if you're part of the receiving crew, you'll come around with a scanner and scan in the inventory count. So this is how we start having a digitalized snapshot of what inventory we have on hand specifically, and we call it perpetual, because perpetual basically means like this. As soon as we receive it from the receiving dock, that product comes in, it gets in the back warehouse, they depalletize the back pallet specifically, and once they segregate the pallet, because usually when you do an LTL order, the LTL orders will come with multiple different kinds of items that don't always pertain to the same department. So the receiving crew would bring it in, the night crew would probably come over and break apart that pallet specifically and put it in the inventory places where it needs to be, or on the carts in order for it to be restocked on the store shelf, either during the day or specifically at night when we do a lot more of our restocking. So at that point in the motion, that is new inventory that's being moved through our back storeroom to be put out on the store floor itself today. So what would happen is we would then, the perpetual inventory system will end up being increased because the receiving clerk ended up accepting that inventory in. So now on your computer, the numbers are going to show that you have more inventory than with what you expect to have. So when a customer comes in to purchase an item, then that customer would go take that item directly to the checkout counter. They would talk to the teller or do their own personal scan. And as they scan the item is now because it's being purchased, and that transaction between buyer and seller from the retailer is actually happening. And when that consumer, as soon as it scans it through the till, it depletes the computerized inventory system. So every time that the computer sees that the UPC has been purchased, the perpetual inventory system then will decline to a point to where there will be a specific threshold that the retailer will set directly for a reorder of that item to happen, formed as an EDI. So an EDI is an electronic reordering system that we do directly through our inventory. So just remember two things for chapter 5. 5 and 6 is together for your quiz specifically, but I just kind of wanted to touch upon this because we're going to hit really heavy into chapter 6 for inventory. But remember that there's two types of inventory that can be taken, right? The first one is known as a periodic or cycle count or physical count. I usually just call it cycle count inventory. So periodic is one time a year or once a month. Usually at the end of the month, we take inventory on all the products that we have. Companies also pay a third party specifically to pay for an independent third party company to come in and do an entire physical count inventory of their entire store. Specifically, they do that for tax purposes. So therefore, when they're ready to file their corporate taxes specifically, they can have every asset accounted for. Okay. The second part is called the periodic inventory. The perpetual inventory. The perpetual inventory is basically when it's a computerized inventory that is depleted every time a UPC of that specific item is being purchased. So as soon as that purchase or that transaction takes place, then the UPC would, the quantity of the item would be decreased. And then the order would refill as soon as that product came in through the back receiving dock specifically. And that is it. So I look forward to seeing you for chapter 6. Bye.